The Big Short depicts two distinct sides of the 2008 housing bubble. Those that saw a disaster forming, such as Michael Burry and Steve Eisman.
Hey, there's a bubble.
How do you know?
Trust me, call Venet. Like 50 million.
And those who actively contributed to creating one of the worst financial crises ever.
I assume no risk for these products myself, Mark.
But while we know Burry's Big Short bet ultimately paid off, earning him and his clients hundreds of millions of dollars, you might not have heard about what happened to those who were perpetuating the economic crisis with their greed and fraud. And at the top of the list is this guy. Played by actor Byron Mann, this character in The Big Short is a depiction of a person named Wing Chow, who was a portfolio manager at his firm Harding Advisory during the early 2000s. And this scene where he sits down with Steve Carell during a subprime mortgage convention in Las Vegas actually happened, according to Steve Eisman. Eisman, whose character's name in the movie is Mark Baum. Yes, I know it's confusing, but Eisman flew to Las Vegas with Greg Lippman and the team to see firsthand how much reckless gambling was being done within the financial side of the housing market. And that's where he met Wing Chow, a CDO manager. A CDO, or collateralized debt obligation, is a financial product where thousands or even millions of mortgages are bundled together and sold to investors who make money as people pay their mortgages. It's actually a really neat way for banks to offload the risk of the loans that they're writing. Instead of just sitting on a huge pile of mortgages waiting for people to pay them down to receive their money back, they just bundle them together into CDOs and sell them off immediately. Well, during the early 2000s, we now know that these CDOs, even though they were AAA rated by the ratings agencies, were filled with really, really bad loans. Mortgages that had been handed out to people who already had other debt, poor credit scores, or even people with no jobs.
Well, my firm offers ninja loans. No income, no job.
And banks could get away with this because of their close relationships with CDO managers like Wing Chow. Banks would write bad loans and bundle them into mortgage bonds and CDOs. The CDO manager would then buy the bank's shitty loans without looking too closely, and in exchange for that relationship, the bank would recommend clients for the manager's investment fund. Oh, and the ratings agencies that were supposed to be checking the quality of these bonds were just rubber stamping everything, because if they didn't provide the ratings that the banks needed, then the banks would just go down the road to a different ratings agency. So you had banks, ratings agencies, and these dodgy portfolio managers basically colluding to defraud investors who thought they were buying safe mortgage-backed assets. During this scene, Steve Eisman realizes that not only is the industry for CDOs massive and speculative, but there's an even bigger market for something called a synthetic CDO.
What did you synthetic CDOs?
Synthetic CDOs.
That is f***ing crazy.
It's not. It's awesome.
I'm not going to bore you with a lengthy explanation of this, but basically synthetic CDOs allowed a person to act as a sort of insurance provider against mortgage bonds. If you owned synthetic CDOs, you collected premiums from people like Michael Burry, who thought the housing market was going to collapse. And if it did collapse, you'd have to pay out the value of the mortgage bonds, just like an insurance company would pay you out to cover your car accident. And the synthetic CDO market was 20 times larger than the actual market for mortgages. This was the night Steve Eisman realized that even a small rise in mortgage defaults could start a chain reaction that destroys the entire financial system. So what exactly happened to this guy after the GFC? Well, the Securities and Exchange Commission investigated his firm Harding Advisory for fraud. They found that he made about $40 million in fees from the fraudulent relationship that he had with the bank Merrill Lynch and a hedge fund called Magnetar Capital. And ultimately, he was barred from being associated with any investment advisory firm, including being banned from being an employee, director, or having any other role. And according to Reuters, he was also fined about $7 million. Oh, and after a year, he was able to reapply to get back into investment advisory. So basically nothing happened to him. Oh, except he tried to sue Michael Lewis and Steve Eisman for his depiction in the book. The Wall Street Journal reported that Chow claimed that Eisman lied about what was said and discussed during the Las Vegas dinner, such as Chow admitting to knowingly selling junk investments, so he sued them for defamation. However, nothing ever came of the lawsuit. But what about this iconic scene, where Steve Eisman faces off in a debate with legendary investor Bill Miller? This was right around the time where mortgage default rates were starting to rise and the beginning of the end was approaching. And according to Eisman, not only did this scene actually happen, there was once footage of it that is unfortunately lost to history.
There is actually a tape of me somewhere in this world of that speech. I used to have it, but I lost it.
At the time, Bill Miller was the chief investment officer of an asset management firm called Legg Mason Capital Management, which had a very large investment in Bear Stearns, one of the investment banks with huge exposure to the subprime mortgage crisis. And the debate represented the perfect contrast between the arrogance and greed of Wall Street and outsiders like Eisman, who knew what was about to happen.
From the time you guys started talking, Bear Stearns stock has fallen more than 38%. Would you still buy more?
Yeah, sure. Of course I'd buy more. Why not?
Boom!
Also, while I was researching this, I noticed that on his Wikipedia page, it says he's known for beating the market from 1991 to 2005, which I know is actually a very impressive record, but I still thought it was kind of funny that his record ended right before the financial crisis. It's kind of like saying that my house survived tornadoes just, up until a tornado came by. But all jokes aside, nothing bad happened to Bill Miller after the crisis. He was obviously wrong about Bear Stearns, but continued to have a successful portfolio management career, and he's now running his own firm, Miller Value Partners, with his son. But what about the guy who flushed $9 billion down the toilet in what is now known as the 5th biggest trading loss of all time? Howard Hubler isn't actually shown in the Big Short movie, but his story is explained in this scene between Steve Eisman and his Morgan Stanley boss. The first time I watched this movie, I didn't really understand the gravity of this scene because it's kind of a sideshow to the other stuff that's going on in the movie. But once I actually learned about what happened, it's kind of crazy and kind of important, so strap yourself in. Howard Hubler was a bond trader for the investment bank Morgan Stanley, but in the movie, he's referred to as Benny Klieger.
2 years ago, Benny Klieger in Morgan's bond department also started shorting subprime housing, $2 billion in triple Bs.
Benny is smarter than I thought.
Hubler was one of the first people to start betting against mortgage bonds. In 2003, through Morgan Stanley, they created the first credit default swap, a financial contract that could be used to bet that subprime mortgage bonds would fail. Subprime, of course, meaning just the worst quality bonds, the ones that were the most likely to fail. Credit default swaps are like buying insurance on a bond. The buyer of the credit default swap pays a premium to the seller, and if the bond fails, the seller pays out the value of the bond. And it's actually the exact same contracts that Michael Burry would use a few years later to bet on high quality bonds failing. But for now, in 2003, Howard Hubler was using credit default swaps to bet that subprime, these shitty bonds, were going to fail. And he was having a lot of success with it. But there was a problem. Even though Hubler was right about subprime bonds failing, he had to pay out huge premiums in the meantime while he actually waited for the bonds to go into default. So to cover these temporary expenses, he made what he thought was a safe bet.
No, he's not smart at all. The premiums on the swap ate into his desk's profit. To cover his triple B shorts, he sold a lot of A and AA swaps as protection, a lot.
Hubler's disastrous mistake was thinking that higher quality mortgage bonds, A, AA, and AAA rated bonds, were safe from the mortgage bond crisis.
He believed that there was no way that they could be affected.
So he sold an enormous amount of credit default swaps on these bonds. So basically, he was one of the people on the other side of Michael Burry's Big Short bet, selling insurance on A-rated mortgage bonds and CDOs. We now know that even the AAA-rated bonds were filled with a lot of subprime mortgages. So in the end, they were basically not any better than the bonds that he was shorting himself. Hubler's $2 billion correct bet against subprime mortgages was now dwarfed by a $15 billion incorrect bet on AAA mortgages.
What's your exposure, 3 billion? Please don't tell me it's more than 4.
The long exposure is $15 billion.
Before the market ultimately collapsed, Hubler was able to sell about $5 billion of those swaps, which meant that he was able to reduce his downside exposure to about $10 billion. And then once you take into account the $1 to $2 billion that he made profitably on the subprime bets that he was making, in the end, his loss was about $8 to $9 billion for Morgan Stanley, which at the time was the fourth largest trading loss in history. And in the movie, we learn that this was a disaster for Steve Eisman as well, because Eisman's fund, Front Point Partners, was a unit of Morgan Stanley, meaning if Morgan Stanley ended up filing for bankruptcy, he and his clients would have lost everything anyway.
All this time I've been trying to figure out who I'm betting against, and it's Morgan Stanley, which is me.
Morgan Stanley was ultimately one of the banks that was bailed out by the Federal Reserve in the aftermath of the financial crisis, which means we can also see all of their financials from the GFC on Ticker Terminal. Their total assets fell from $1.1 trillion in 2006 to $650 billion by 2008. And you can even read the transcript of the quarterly conference call from 2007, where management had to tell investors about the huge mistake that they'd made with credit default swaps. If you're like me and you love diving into financial data and records for different companies, then stick around for a little bit in this video. I want to talk about a very special deal that I was able to get for my audience with Ticker. Ticker Terminal is a comprehensive platform for supercharging your investing research. You can search through 100,000 stocks across all major global markets, using their stock screener to filter by country, industry, financials, valuation ratios, Wall Street analyst recommendations, and much more. And if you don't want to do your own screening, you can take a peek at which stocks are owned by the biggest investment funds in the world, such as Warren Buffett's Berkshire Hathaway, and you guessed it, Michael Burry's Scion Asset Management portfolio. Ticker gives you access to the portfolios of over 10,000 investors from around the world. The financial data Ticker has on stocks is the best I've seen on any platform. Easily analyze and visualize income statements, balance sheets, cash flow statements, ratios, and much more. They calculate valuation for you using pretty much every method you can think of, and you also get a detailed view of what Wall Street analysts are forecasting for companies, including their 12-month price targets. And there's so much more on the site, such as tracking and monitoring your portfolio, following important investor news, and trading from those inside the company. There's a free plan, so if you want to check out some of their basic features, you've got absolutely nothing to lose. But if you want to join the Plus or Pro plans, there's a 14-day free trial, and you get 25% off if you sign up to an annual plan. But in case that wasn't enough for you, I reached out to Ticker personally and got an even better deal for you. So for the next few weeks, if you use my code HAMISH15 when signing up, you'll also get another 15% off the first payment cycle of any of Ticker's plans. That means that the Plus plan, for example, is about $12 per month if you sign up annually, which is an insanely good deal given what you're getting access to. So don't sleep on this offer if you're looking to step up your investing game.